Welcome to another Theory Thursday. My name is Justice Roberts and I am a loan officer with Paramount Residential Mortgage. Today we are going to break down some lending for you in 3 separate categories. Number 1 is programs, number 2 is down payment assistance, and number 3 is monthly payment. The first program that I would like to talk about is an FHA loan. FHA is short for the Federal Housing Administration. Some benefits of an FHA loan are low down payment requirement of 3.5% and a low credit score requirement of 620. In some cases it's lower, however this is the typical benchmark. Another excellent loan option is a conventional loan. Now, a conventional loan where the rate might be a little bit higher than some other loans, the overall monthly payment is typically less because the lower upfront monthly fees. Another benefit of a conventional loan is that there are typically less loan requirements because you are putting a bit more money down, such as maybe 5%, and your credit score is a bit higher, which lets the lender know that you are more likely to make your payments. Moving right along to another fantastic loan option, we have the VA loan. This loan is made specifically for individuals that are currently serving or have served in our military force. There are many incentives such as no money down, a credit score requirement of a 620, in addition to lower monthly fees. If you are a veteran, I highly suggest seeing if this loan would be a good fit, as it is an amazing option. Last but definitely not least is a USDA loan. This loan program is a United States Department of Agriculture loan. It is another great zero down loan option for customers looking to move to more rural areas. There are 2 things to consider for this loan. Number 1, like I mentioned, rural areas, which means that a property has to be in a certain location in order to qualify. And number 2 is that there are income caps that you have to make sure to be under in order to qualify. Based off of how many people are living in your home, these numbers will be different. Make sure to check with your lender in order to find out if this is a viable option for you. Next, we have down payment assistance. DPAs can be paired with several loan options such as an FHA loan, a conventional loan, or even a VA or USDA loan. The highest benefit for having a down payment assistance is the fact that you are not required to come up with a down payment. Other benefits include only requiring a 620 credit score. There are a few things to consider to see if a down payment assistance program is right for you. Number 1 is qualification limits. Because you are getting all the funds from a down payment assistance, you have less skin in the game than if you were going to come up with the down payment all yourself. Because of this, there are some tighter restrictions on what the bank will lend you. Number 2, interest rate. Every program has different interest rates, and this is very true for a down payment assistance program. Typically, you will notice that rates are noticeably higher than current market. You absolutely get the benefit of not being required to come up with a down payment. However, it is critical to know all the facts. Monthly payments. There are several factors that make up your monthly payment. Number 1 is principal and interest. This amount goes to pay both the amount that you owe the bank as well as the cost to borrow it. Number 2, taxes. This cost will vary property to property depending on how the county determined the cost for that specific parcel. Number 3, homeowner's insurance. This is required for every property as it protects you and the lender if something were to happen to your property. Number 4 is mortgage insurance. Now, mortgage insurance is the lender's insurance policy in case of default. Typically, every loan will require mortgage insurance in some form or fashion unless you have at least 20% equity. Different loan programs have different names for these and different costs associated. As there are many options depending on your loan program, it is best to go over these specifically with your lender. Number 5 is homeowner association dues. Now, HOA fees are calculated regarding your monthly obligation. However, this is the only item that is not directly a part of your mortgage payment. If your property has HOA, you will pay directly to the HOA and separate from your monthly bill. I hope you enjoyed this Theory Thursday. Again, my name is Justice Roberts, and we'll see you later.